When it comes to luxury real estate, there's a fatal mistake most people make without even realizing it. Confusing prestige with yield. Imagine a dream villa with a sea view, a breathtaking penthouse in the heart of a historic center, or perhaps a palazzo designed by a renowned architect. These are, without a doubt, extraordinary objects. One-of-a-kind pieces, true works of art that shine in the real estate landscape. But this is where the deception begins. Their intrinsic magnificence does not automatically make them an investment. The question every true investor should ask isn't, is it beautiful? Do I like it? Does it create status? The real question, the one that distinguishes the dreamer from the analyst, is, does this property produce measurable and sustainable value over time? And it is precisely on this subtle but crucial difference that we want to shed light on today. Because navigating the luxury market without an analytical compass can be costly, very costly. Many fall into the emotional trap, convinced that the high cost and exclusivity are in themselves a guarantee of a good deal. But the world of real estate investing, especially high-end real estate, is much more complex than a simple aesthetic love at first sight. What we'll reveal to you today are the inconvenient truths and numbers that no one really analyzes, allowing you to distinguish a real deal from a costly mistake. The first fundamental point to remember is that luxury, in itself, is no guarantee of returns. Indeed, it can often hide unexpected pitfalls. Think about the traditional market. The value of a property is often dictated by widespread demand, by widespread housing needs that create a constant flow of buyers and sellers. It's a market driven by large numbers, by statistics that encompass a significant portion of the population. But in the luxury segment, the rules change radically. Here, demand is limited and highly selective. We're not talking about thousands of potential buyers, but a few dozen, sometimes just a handful, of high net worth individuals or families with extremely specific requirements. This niche, though rich, is also incredibly sensitive to economic cycles. A downturn, political uncertainty, or a sudden tax change can topple the entire house of cards. Let's see how a high-end property behaves in different economic scenarios. In periods of expansion, of great optimism and growth, it can rise dramatically, registering appreciable gains. The bubble inflates, driven by euphoria and the availability of capital. But when uncertainty looms, when the economy slows or enters a phase of stagnation, the same property can remain stagnant for years. Its nominal value may not even decrease, but it simply won't find buyers willing to pay the desired price. And the real tragedy arises in moments of acute crisis. Then the luxury property can become illiquid. Completely. Which means that no matter how extraordinary, you won't be able to sell it even at a bargain price, because there's simply no demand, or those with the capacity to buy it prefer to wait. The critical variable to analyze, therefore, is not the seller's asking price, nor the intrinsic beauty of the property. The truly fundamental metric is the actual liquidity of the market. How easy is it to sell such a property at a given time? How long does it take? How many qualified buyers are there? Ignoring this aspect is walking a fine line, believing you possess a treasure that, in reality, could turn into a gilded prison for your capital. Don't be fooled by the gilded patina. Dig deeper and always ask yourself, if I needed this property tomorrow, under what conditions could I monetize it? The answer to this question is often more revealing than any figure on a sales sign. In real estate, the adage location, location, location is a truth set in stone. But in the premium segment, this truth is refined, becoming almost microscopic. It's not just the city that matters, and often not even the neighborhood. What matters is the micro-location. It's a concept that many underestimate, thinking that simply being in a good area is enough to be safe. Nothing could be more wrong. In luxury, the difference between a brilliant investment and a mediocre one can be a matter of a few meters. It's not just the prestige of the street that makes the difference, but intimate and specific details. Sun exposure, for example. A property with the right exposure can be worth significantly more than an identical one with a different orientation. The view. A breathtaking, uninterrupted, and guaranteed panorama is a priceless luxury. But be careful, because the same view, perhaps just from the opposite side of the street, could be obstructed by another building, or not enjoy the same brightness. And what about privacy? In luxury, exclusivity isn't just an option, it's a fundamental requirement. A penthouse with a screened terrace inaccessible to prying eyes will have a very different perceived and actual value than one where you are constantly exposed. Then there's the floor plan. A penthouse, a main floor, and a ground floor with a private garden. Each level has its own unique characteristics and market positioning, but also the architectural context of the building itself. A carefully restored historic palace, an iconic architecture signed by a famous name, a villa with a unique design. These elements are not just aesthetic details, they are factors that contribute to creating an aura of uniqueness. Think about it, two properties located in the exact same neighborhood, sometimes even on the same street, can have a difference in value ranging from 30 to 50%. This is because one overlooks the park, the other an internal courtyard. One enjoys bright light all day, the other is shaded for much of the day. One has a private and discreet access, the other is in a more heavily trafficked condominium. Micro-location, in this segment, is everything. It's not just about the address, but a set of almost surgical characteristics that define the uniqueness and desirability of a property. Ignoring this level of detail means giving up one of the most powerful levers for optimizing your investment, relying on luck rather than careful analysis. A luxury property has a powerful emotional component. There's no doubt about it. Buying a historic villa or a designer loft is often a dream come true, a symbol of success, a place to build precious memories. Emotion is an integral part of the luxury experience, and rightly so. The problem arises when this emotion, this passion, clouds financial judgment. The intelligent investor, the one who truly knows where to put his money, must learn to drastically separate what pleases from what pays. One of the biggest mistakes, a trap that even experienced investors fall into, is buying a luxury property thinking, someone will love it as much as I do. Its emotional value is so evident that anyone will appreciate it. Unfortunately, the market doesn't work that way. Love for a property is a personal feeling, not a universal metric. The market is a cold, rational entity, or should be, from an investment perspective, responding to objective, measurable dynamics, not emotional affinity. A successful real estate investment, especially in luxury, is based on a series of factors that transcend personal taste. Actual rarity. Not perceived or self-proclaimed rarity, but concrete rarity. How many similar properties exist? How many can boast that view, that history, that size, that finish in that micro-location? True rarity creates a limited supply, which, when there's demand, props up prices. International demand. A property that attracts buyers from all over the world has a much larger and more resilient market catchment. Local economic fluctuations have less of an impact if there are international investors ready to step in. This creates a sort of safety cushion, legal stability of the country. This is an often overlooked aspect, but it is of paramount importance. A clear, transparent, and stable legal system that protects private property is essential. No one wants to invest large sums in an environment where the rules can change overnight, where bureaucracy is stifling, or where property rights are ambiguous. Legal certainty is a cornerstone of investment. Tax attractiveness. Property taxes, inheritance taxes, rental income taxes, and incentives for foreign investors. All these factors directly influence the net return and desirability of an investment. A country with a favorable tax regime can attract capital, even in sectors that aren't strictly luxury, but benefit from the influx of wealth. Future infrastructure, urban development plans, transportation improvements, high-profile new construction, investments in luxury amenities or technology hubs. These future developments can transform an area, exponentially increasing its value and long-term desirability. The investor must be an emotional surgeon, capable of isolating feelings and basing decisions exclusively on these concrete parameters. Only in this way can a luxury property go from being an expensive whim to a strategic asset, capable of generating real and measurable value. Don't fall in love with the property, fall in love with the numbers it produces. The allure of luxury is so powerful it can make us forget the fundamentals of investing. Those who buy luxury too often ignore or downplay a series of crucial numbers. Those figures that, if analyzed rigorously, would reveal a reality far different from expectations. Let's look at these often overlooked metrics which can make the difference between a good deal and a permanent cost. First among these is the real net return. Not the gross return, but what remains after subtracting all expenses. And here we come to the second point, high maintenance costs. A luxury property, to maintain its prestige and functionality, requires constant and significant investments. Pools to maintain, lush gardens to tend, advanced technological systems to update, high-quality finishes to maintain. We're not talking about a small faucet repair. We're talking thousands, sometimes tens of thousands of dollars a year just for ordinary maintenance. And then there are the property taxes. In luxury, these aren't just simple taxes, but real bloodlettings. Property taxes, registration fees, inheritance taxes, often progressive and very heavy, erode a significant portion of the capital in return. Let's not forget management costs. If the property is intended for high-end rentals, the cost of a specialized property manager, concierge services, and security can be astronomical. And last but not least, long vacation periods. A luxury property is not just any vacation rental. Finding the right tenant willing to pay high rents can take time. Months, sometimes years, during which the property generates only costs and no income. The result of this analysis is often surprising. In luxury properties, the percentage return is often lower than in mid-market properties. A well-located two-bedroom apartment in a large city can have a higher annual return as a percentage of the invested capital than a multi-million euro villa. This is an uncomfortable but undeniable reality. So the question arises, why do wealthy individuals continue to invest in luxury properties despite these seemingly less attractive returns? The answer lies in three fundamental reasons, which go beyond the mere logic of immediate cash flow and reveal a more sophisticated financial strategy. Asset protection. In times of inflation or economic uncertainty, luxury real estate, especially in unique micro-locations, is seen as a safe haven. A brick that, while likely to fluctuate in the short term, tends to maintain and sometimes increase its real value over the long term, protecting capital from currency devaluation. It is a physical anchor to wealth. Diversification is crucial for a robust investment portfolio. Luxury real estate offers a distinct asset class with its own dynamics that can counterbalance other forms of investment: stocks, bonds, funds. You don't put all your eggs in one basket. Beyond immediate returns, luxury real estate is often a status asset. It's not just a financial investment, but a symbol of prestige and an asset that, due to its rarity and quality, is destined to retain its intrinsic value for decades, if not centuries. It's a generational transition, a tangible legacy that transcends trends and market fluctuations. Understanding these three pillars is essential for anyone approaching the luxury real estate market. It's not a race for quick returns, but a long-term strategy for preserving and growing wealth, requiring patience, liquidity, and a deep understanding of its unique dynamics. Ignoring these numbers and motivations means not only losing money, but also misunderstanding the entire philosophy of high-end investing. After having revealed the pitfalls and often ignored numbers, the crucial question is there a time, a condition, in which luxury real estate can be considered a good investment? The answer is yes, but under precise and stringent conditions. It is never an investment for everyone, nor a gamble. It is a strategic, thoughtful choice that requires a long-term vision and a solid financial foundation. A luxury property becomes a smart investment when it's in a global city with stable international demand. Think of capitals like London, New York, Paris, Milan, or Hong Kong. We're not talking about any big city, but those that serve as hubs for finance, culture, fashion, and elite tourism. These cities consistently attract capital and people from all over the world, creating robust and diversified demand for the luxury segment, even in times of local uncertainty. Their resilience is linked to their centrality on the global scene. It's in a truly unparalleled location. This ties in with the concept of micro-location. A beautiful location isn't enough. It must be a unique place, with features impossible to replicate. An unobstructed sea view guaranteed forever, a view of a historic square protected by conservation regulations, a plot of land on a hill with a 360-degree panorama, a historic building with a glorious past and unmistakable architecture. Unrepeatable quality is the key to true rarity and intrinsic value. Buying below market value. This is every investor's dream, but in the luxury sector, it's even more difficult and critical to achieve. It requires the skills to correctly evaluate the property and recognize an opportunity, perhaps dictated by the seller's urgency or a downturn in the market. Buying below its true potential creates a margin of safety and the potential for appreciation from day one. It requires knowledge, patience, and the ability to act quickly. The time horizon is long. Forget the idea of buying and reselling in a couple of years for a quick profit. Luxury real estate is an investment that is thought of in decades. You buy with the expectation of holding the property for 10, 20, 30 years or more. This allows you to absorb market fluctuations, benefit from long-term appreciation, and transform annual fixed costs into a more manageable percentage of the overall value. You don't depend on immediate cash flow. This is crucial. A luxury investor must have sufficient liquidity to cover operating costs and taxes without having to rely on immediate rent or short-term sales. If you're looking for a steady monthly income to cover expenses, luxury probably isn't for you. It's an investment for those with established assets and seeking a long-term diversification and protection strategy, not a primary source of income. In short, luxury isn't for those seeking quick returns. It's for those who think in decades, with strategic vision and a solid financial foundation. It's for those who understand that true value isn't measured in quarters, but in generations. If these conditions aren't met, what appears to be an investment could turn out to be an expensive luxury, a financial burden rather than a valuable asset. We've explored many facets of luxury real estate investing, but there's one mistake, more subtle and pervasive than the others, that deserves special attention. The biggest mistake is buying luxury to feel like a sophisticated investor. This isn't a strategy, but an ego trap. Many people, once they've achieved a certain level of financial success, feel the need to demonstrate their sophistication to themselves and the world through material possessions. And luxury real estate seems like the perfect culmination of this ambition. But true sophistication, the one that counts in the world of investing, isn't in the price of the asset at all. It's not in the number of zeros you spend. True sophistication is in the analysis. It's in the ability to look beyond the facade, to dig into the numbers, to understand market dynamics and anticipate risks. It's not the most expensive investment that makes you a better investor, but the smartest, most thoughtful investment, not most strategically aligned with your goals. The true investor, the one who operates with wisdom and not vanity, never asks himself, how much does it cost? This is the question asked by those who buy a consumer good or seek a status symbol. The true investor asks a much deeper and more crucial question. What is the invisible risk? This seemingly simple question encompasses a universe of considerations. What is the real liquidity of this asset if I were to sell it quickly? What are the hidden management and maintenance costs that aren't immediately apparent? Are there any regulatory or tax risks that could emerge in the future? What are the long-term value degradation factors I'm not considering? Am I aware of the specific market cycles of the luxury segment in this micro-location? Have I checked the country's political and economic stability and its implications for ownership? These are the questions a sophisticated investor asks, knowing that invisible risk can erode capital in unexpected ways, turning a dream into a financial nightmare. The excitement of prestige can be blinding, but critical analysis and the search for invisible risks are the lens through which to filter every opportunity. Don't be fooled by the allure of luxury for its own sake. Your true skill as an investor lies in the depth of your analysis, not in the high price you're willing to pay. We've taken a journey through the complex world of luxury real estate, debunking myths and exposing often uncomfortable truths. A luxury property can undoubtedly be an architectural masterpiece, a powerful symbol of success and status, or an extraordinary form of wealth protection. It's an asset that enchants, attracts, and inspires. But as we've seen, it's by no means automatically a smart investment. Its beauty and high cost are not synonymous with guaranteed returns or the absence of risk. The real difference between an emotional purchase and a strategic, profitable investment lies in the method. A rigorous, analytical, almost scientific method that doesn't let itself be dazzled by the surface but digs deeper. A method that evaluates every aspect with a critical and detached eye. Because with luxury, you're not just paying for the square footage. You're paying for the property's intrinsic rarity, its unique, impossible to duplicate location, the reputation and history of the building, or the architect who designed it. You're also paying for the legal and economic stability of its location, the certainty that your investment will be protected over time. All these factors contribute to the true value of a luxury property, which goes far beyond the simple construction cost or price per square meter. And only those with the ability, skills, and discipline to precisely measure, quantify, and analyze all these intangible factors rarity, location, reputation, stability, can transform pure prestige into real, sustainable value. It's the ability to distinguish noise from signal, appearance from substance, that determines success in this fascinating yet treacherous investment segment. Don't be guided by instinct or trends. Always rely on analysis. If this insight has opened your eyes to the dynamics of luxury real estate, then be sure to watch the next video where we explore how to identify these unique micro-locations.